joke, and I notice you can hear better if I speak from this side of the microphone, but you know, there was, at the end of last year, I had a lot of clients, some of you may be in the same position, where Congress wasn't doing anything. It looked like we were going back to $1 million applicable exclusion amount, and so I was recommending to my clients, we need to get this $5 million now. This might be your last opportunity, and hopefully none of y'all did too much of that. And Ed was referring to, like I was going to talk about timber tax. I do quite a bit of quite a few timber tax workshops. I'll do a quick advertisement. Right now, to me, the more important thing is not so much tax, but what I call fragmentation. So, dad owned 500-acre working farm, 5 children. Those children had 5 children, 2 generations. We've got 25 people with 20 acres each. No more working forest. So, what do you do about that? Probably form a business entity or trust. I've got a series of workshops coming up on that issue if anybody's interested. The first one's in Atmore on Monday if anybody has to be in that area. Look at AFOA stuff. There'll be some advertisements on that. First of all, this, for anybody that's interested, is the new Tax Act with the explanation. I'm going to read this to you in the 20 minutes I've got. Anyway, maybe not. So what I want to do is just give you some of the highlights from what's in the American Taxpayer Relief Act. And I've got kind of a comment here that I don't want you to go to sleep or walk out, but if you don't have more than $1 million or earn more than $200,000, you're not really going to see much effect. I do have 3 big things I'm going to talk about for you as a landowner that may be of interest otherwise than that. But the good thing, or the good news, I guess, is that all those Bush-era tax cuts are now permanent. Okay, so they were all supposed to disappear, so everybody's taxes were going to go up. Now they are not. So that's the good side. And of course, one of the other things with that was the marriage penalty relief. So that has also been made permanent now. So let me spend a couple of minutes talking about estate tax. I kind of like that a little bit more. So I don't have to bore you with that. So first of all, we reunified the gift and estate tax. So that means your applicable exclusion amount this year is $5.25 million. That is how much you can transfer tax-free to your next generation. Okay? That means that it's $5.25 million either during life or at death. That's what we mean by reunified. Okay, so it's $5.25 million. You can either use it at death or you can use it at life, part at death, part at life. Okay, the actual code says $5 million indexed for inflation. That was from 2011. So last year was $5.12 million. This year is $5.25. I'm going to show you some historical stuff in a minute just to let you see how much better off we are now than we were. The maximum tax rate is now settled at 40. From EGTRA, we got a 45%, and then they dropped it to 35, so they kind of split the difference. We're at 40. Portability is a really big issue, and that's something that is going to be very important. I'm going to mention in just a minute for your estate plan. Just to give you a quick idea of how many people are affected, I just threw some numbers up here. This was actually done in 2010 when they did the first extension of the Bush-era tax cuts, trying to look at how many people would be affected. And so at $5 million, less than 0.14% of the states will actually have an estate tax issue. So it's gotten to be a very small. In fact, there are 2 bills in Congress right now to eliminate the estate tax. One of them is basically eliminated. One of them says eliminate it but make up money somewhere else. So we're actually not through with the estate tax, even though it's been permanent, so to speak. So just to give you a quick idea how bad it used to be, from 87 to 97, it was $600,000 was all you could transfer before you had to start paying tax. Then it started going up $25,000 a year until EGTRA came along, Economic Growth Tax Relief Reconciliation Act of 2011. So jumped to $1 million, and the tax rate was 55%, but there was a 5% surcharge between $10 million and $17,184,000. I can explain why, but I'm not having enough time. But anyway, so you could be paying as much as 60% tax on. So it started dropping 1% a year until it got to 45. 2010 was the throw mama from the train year when there was no estate tax, but then they reinstated it at the end of the year and gave you a choice. You could either pick no or not, or tax. That goes back to basis that Ed was talking about. I'll mention that in a minute. So here's where we are right now, settled in, $5 million indexed. So we're at 5.25. It will probably be 5.350 or even more next year, so 40%. Portability is the really big issue that we got out of this. Well, $5 million is pretty big. Portability, and the reason I want to talk about this, and it's actually on the next slide, so I'm going to kind of go ahead just a little bit here. Probably almost every one of you that has an estate plan has got something that says create a credit shelter trust and a marital deduction trust. Okay? That is no longer necessary. The other thing that your estate planner told you was you needed to equalize assets. So I had a lot of clients that, okay, we got to equalize assets to minimize estate tax, and the spouse all of a sudden got a boatload of money, and it was like, I've been putting up with you for years, now that I got some money, I'll see you later, I'm out of here. Anyway, so no longer any need to do that. So now that we have portability, you need to look at your will or trust. Because I'm betting that if you had one done and you were anywhere close to $1 million, you've got a credit shelter trust. And what that is going to do, the credit shelter trust basically said, take the credit shelter amount and put it in this trust for my spouse and children, and everything else leaving the marital deduction for the spouse. But now that it's $5 million, the whole estate is probably going into that credit shelter trust for the spouse and children, and the marital deduction trust has $0 in it. Unless, of course, you got more than $5.25 million. So spouses, especially if you expect to be the last person standing, you need to make sure that you look at that estate plan, and you probably ought to change it so that you don't dump the $5.25 million in there that you get to share with the children, and they may have some say-so over how it gets spent, as opposed to the marital trust where you would have had control over it. So anyway, the portability now, what that basically means is that once one spouse dies and they don't use the whole 5.25, the surviving spouse has the opportunity to use the leftover, or what we call the deceased spousal unused exemption, or exclusion, excuse me. You do have to file a tax return to do that. So if you are in that kind of situation, so spouse dies, only got $200,000, you do have to file an estate tax return to save that unused. It's not, my spouse died, only gave away $200,000, and now here I am with $7 million, I'd like to use some of this other one. Nope, it doesn't work like that. You have to file an estate tax return, even though you don't owe any estate tax. Anyway, that's one important point I want to get across. So I already talked about that. Okay, if you do still have an estate tax problem, and I hope most of you do, which means you got more than $10.5 million, you're basically doing a gifting program. I'm not going to talk about that right now. So it did mention that the basis a couple of times. Just to be sure everybody's on the same page, you buy stock $60 a share, you sell it at $100 a share. So your basis is 60, you don't pay tax on that, you pay tax on the 40 gain that you've made. Okay, so that's the importance of basis. Basis is the amount that you get tax-free back. Okay, and so when we're talking about transferring assets, you need to understand the two basis rules. So if you are giving something during life, the donee, your children, takes your basis plus any gift tax paid on the appreciation. Okay, so really just remember, donee takes donor's basis. So you've got some property you got from your parents. They paid $100 an acre for it in 1956. And now you're thinking about passing it on to your children. If you give it during your life, and now it's worth $2,000 an acre, you're basically giving them a potential built-in $1,900 an acre capital gains. And so the alternative then would be to leave it in your estate. If you do that, they get a step up in basis to fair market value date of death. And so when you start thinking about, do I give something to children while I'm alive, or do we wait and leave it in the will? You need to be thinking about the basis that you have in the property. And even though it's the family farm and you don't intend for the children to sell it, and by the way, that doesn't happen very often, that's one of the reasons I'm doing these other workshops, because once you got, say, 5 children, you leave an undivided 1/5 interest, any one of those children can force the sale of the property. Okay, and so leaving undivided interest is not the way, in my opinion, which is worth what you pay for it. It's not the way to leave property to children. You need to think about putting it in a business entity or trust. But back to the basis, so if you gift it during life, you maybe don't care about the value of the dirt because you don't intend for them to sell it. But what about the trees? Because we allocate basis between the timber and the dirt. That's what Ed's going to do for you. And so when you sell the timber, you would like to have some basis in it so that you don't have to pay income tax on everything you receive. So anyway, that's basis in a small nutshell. Okay, so what happened with income taxes? We now have a 39.6% tax rate. Remember, we used to have that back in the Clinton era. And then when Bush came along, we got rid of it. Now it's been reinstated. To help pay for the increased health care, we have 2 new taxes. Those are actually not, those are 2010 Health Care Act, not this new act, but I'm going to mention them real quick. So additional 0.9% Medicare tax, and then a 3.8% surtax on investment income. Okay, so investment income, you know, capital gains stuff, we just pay capital gains tax on. Now we got an opportunity to collect another 3.8% when you sell your timber, maybe. Okay, there are a couple other things. I'm going to hit each one of those real quick since I'm running out of time. Let me just talk a little faster. First thing, this is the projected tax table for married filing jointly for next year. The reason I put this up here, quite a few of you probably have a trust. Okay, and so when you have a trust, it's a separate legal entity, got its own tax ID number if it's an irrevocable trust, and it has to file its own tax return. What I want to point out with this slide is that the tax brackets for a trust are very condensed compared to an individual. So you'll notice there's a 10% tax rate on individuals. There is no 10% tax rate on the trust. So the first dollar of taxable income that a trust has gets taxed at 15%. Notice the 35% goes up to $450. So the new 39.56% hits your 400 or the next dollar over 450,000. Again, I hope you have that kind of problem. There is no 35% on the trust. So if you've got $8,750 in a trust, that next dollar gets taxed at 39.6%. So the point I want you to take home from this is that you should be distributing trust income. So when you write a trust, you need to expect that the trust is not going to hang on to the income. The trust needs to distribute that income. Otherwise, you're going to pay an excessive amount of tax on it. So a trust gets a distribution deduction. So if you distribute the $12,000 that the trust earns, trust pays no tax. That money is just like a K-1 from a partnership, flows through to the beneficiary, same character, and the individual pays tax on it. The additional Medicare tax, so it's 0.9%. The threshold amount this year is $250 married filing jointly, $200 single. It's indexed for inflation, and so basically we're paying 6.2% on the first 113.7, just like always, except the 113, of course, changes every year. The 1.45 Medicare tax has been there for quite a while. That's on every dollar. So even when you get to the 113.7, you pay 7.65 up to 113.7. Anything over that, you pay 1.45. Once you get over 2 or 250, depending on how you file, you pay 2.35%. Okay, so first opportunity to help the new healthcare system out. The other one is this Medicare Surtax. It is on investment income. So earned income, your wages, is not subject to this 3.8%. Only your basically unearned income, or what they call net investment income. And again, there's a threshold amount, and it's the 250 and 200. And same thing for a trust. So let me just hit this real quick. So what is net investment income? So your typical investment, interest, dividends, annuities, gross income from a passive activity. So my next comment that I'm going to talk about is, should your timberland be an investment or should it be a business? So you think about that for a minute. I'm going to say something in just a minute. Okay, so if you do have, or if you have organized your timber owning as a business, then it will be, if it's not a passive activity, well, I'll get to that in just a minute, but anyway, net investment income includes income from passive activities. It also includes capital gains. So when you sell your timber, that is investment income unless it's in a business that's not passive. Okay, there are some things that are excluded. So like if you sell your principal residence, that's a capital gain, but remember the first 250 or 500 is not taxable, so it's not in there. Anything over that amount, it would be. Okay, there's also an exception for qualified distributions from a retirement plan. So your IRA is not subject, plenty of time, just like it said, plenty of time. Okay, so here's a quick example how this works. So husband and wife earn 200. They harvest some timber worth 500. Their modified adjusted gross income. So when you see this MAGI here in a minute, I think I just went 5 minutes and forgot to tell you that that's what the abbreviation was for. So 250, they're under the threshold, no 3.8% tax. Suppose though, they get a $40,000 distribution from their IRA. So we know the IRA is not taxable on this additional Medicare Surtax, right? But what happened then is it just bumped your modified adjusted gross income up to $290. So $40,000 of that timber income is now subject to the 3.8% tax. And so there's a planning opportunity here. So if you're getting close to the 250, you need to think about that. So 3.8% on 40,000, that's only good. Hardly drop in the bucket when we plant that. Anyway. All right, so should your timber be an investment or a business? Trying to throw something in for the people that are making less than $200 anyway. So how does the IRS know whether you are operating your timber holdings as an investment or as a business? And the answer is they know based on the schedule that you file. So if you are filing a Schedule D with all your capital gain type stuff, and that's where you put your timber, then you are holding your timber as an investment. If you file a Schedule C, then you're a business. Why do we even care? It's not a big issue, but if you are operating as an investment, then your expenses are basically miscellaneous itemized deductions subject to 2% of AGI. So in other words, quick example there, you earned 100, you sold 10 worth of, or you have $10,000 expense to replant trees. You can only basically get the benefit of $8,000 if it's an investment as opposed to the whole $10,000 if you're a business. So it's $500 that you just threw away by being an investment as opposed to a business. The other thing, of course, is if it's a business that you are actively involved in, it will not be subject to the 3.8%. So that's another advantage to operating as a business as opposed to investment income. Okay, so real quick, a couple of other points. Capital gains, remember we used to be 20%, so they made the 15% permanent. So if you are in the 15 or 10 or 15% income tax bracket, your capital gains rate is 0. If you're 25 to 35, your capital gains rate is 15. If you have to be 39.6%, then you get to pay a 20% capital gains rate. Okay, so that's one of the things that they made permanent. The qualified dividends, remember dividends used to be ordinary income, and it was going back to ordinary income January 1st. That's another thing that got saved in this new tax act. So dividends are now capital gains permanently. Two other things that they're put in there to raise taxes are the phase out of itemized deductions. In this case, the threshold was 250 and 3 instead of the 2 and 350. And since I'm about out of time, I'm just going to mention a couple of these. There's also a phase out of the personal exemption. It also is in the 250 and 3. If anybody happens to want these slides, email me, I'll send you a copy of them. Alternative minimum tax has been fixed. Remember, they used to have to raise the amount every year, so they finally have made that permanent. The amount is $78,750 married filing jointly, and that amount will be indexed for inflation for each year. And so if you used to wait for Congress to see if they were doing the changing it, it's now been made permanent. So there's just a real quick, starts phasing out. Some other changes, the 50% bonus depreciation allowance has been extended for 1 more year. So that's not, you don't get anything extra, you just get it early. So you can claim 50% bonus depreciation first year you buy a piece of equipment instead of the typical 20% you would normally get the write-off for a piece of 5-year equipment. If you happen to be 70 and a half and are giving money to out of your IRA, that's still around. Conservation, the real property conservation easement is still, instead of the 30% of income, you can do 50%. The itemized deductions for states still out there. Anyway, I think I'm out of time. I'll quit here. This is my last slide anyway. Thanks for listening. Tax is always a great subject to have at the end of the day.